Good evening, everyone. A very warm welcome to all of you. I'm Manohar Vadhwa from PMS Bazaar. We have a very interesting webinar lined up today on pre-IPO opportunities under the alternate investment fund route. As you all know, the way Indian economy is growing, the current GDP of $3.5 to $4 trillion is expected to grow to over $10 trillion in the next 8 to 10 years. This rapid growth will have to be funded somewhere. The traditional forms of raising funds were either from capital markets or debt markets. What we have seen of late is increasingly paving way to alternates as one of the main source of raising funds. And within alternates, as you are aware, we have different categories like venture capital, private equity, private debt, and also pre-IPO. So in this webinar, what we'll do is we'll focus on pre-IPO opportunities. And to discuss this further, we are joined a very eminent guest today by Mr. Nishad Khanolkar. Nishad is the fund manager of Bharat Value Fund. Welcome to the show, sir.
Thank you. Thank you, Manoj.
Yeah. Just to give a brief background about Nishad ji. Nishad is a chartered accountant and associate member of CPA Australia. He has a rich experience of global fund management of 17 years, in addition to 5 years of corporate finance. Previously, he was the CEO of SP Growth Ventures, an asset management company based out of Hong Kong. Currently, he's associated with India Inflection Opportunity Fund, Category II AIF, managed by Pantomath Group, and he's there since the day one of the fund launch. They just recently closed their first fund around 6 months back, where they raised almost 500 crores in commitment. Based upon that success, this is the second fund from their family, and this is called as Bharat Value Fund. The target size or the fund size is 1,000 plus 1,000 crores. That is, the extra 1,000 is the green shoe option. So the way Bharat Value Fund is positioned, it focuses on the mid-market pre-IPO opportunity with a 𝐻𝐜 opportunity. It is fully exit-oriented, where they have the in-house mechanism to both enter and exit. What I'll do now is I'll hand over the podium to Nishad ji, who will give us a detailed presentation, and this will be followed by Q&A. I would request all the participants to post the questions in the Q&A box. Nishad ji, over to you, sir.
Thank you, Manoj, and warm good evening and welcome all the viewers. So before I start upon my presentation, as I always say, let me structure my presentation into the 4 parts. The first part, I'm going to explain a little bit about what is coming viewers' way. So what you can expect, I'm going to speak in next 30-35 minutes, that I'm going to set the tone in the first part. The second part, I'm going to talk about the background about the group, because the Pantomath Group and its other entities, how their achievements in last 10 years, 20 years, and how that supports the fund management activities. The third part, I'm going to speak directly about the fund. When I talk about the fund, I'm going to discuss 4 points. The number 1, the exit. The number 2, entry. Number 3, where do we make money? Yes, paisa kahan kamate. And number 4, the safety. Safety comes first, returns comes later. That's the part C. And the last part we can directly go for the Q&A. So that is how I'm going to structure the presentation. So first come first, what viewers can expect from this particular presentation. Manoj, while you was giving about my background, the opening statement that you made, I really like that statement. That made my job very easy. You said about the 3 trillion economy going to 10 trillion economy, and we all have belief in that. I need not have to go deep dive into that because we all understand, we all agree to that number. So from where that, who is going to support that? That means the new and new age companies has to come into the listed market. So what we are going to discuss today is that we are going to discuss about the unlisted opportunities. SEBI has basically, the regulators have 3 categories into the alternate investment funds category. The category 1, category 2, and category 3. Category 1 is more about the startups, venture capitalists you can talk about. Category 3 is more about the listed segment. quite closer to PMS, though they do have some differences between PMS and Category 3. And Category 2, what we are going to discuss today is about the unlisted to be listed. So how the unlisted to be listed segment can be made with the element of safety. That is what we're going to discuss. The predominantly, if you have seen the unlisted sectors, people have made the good money, provided the only the catching point into the Category 2 or the unlisted segment was something called as the element of exit. So if you could manage that, the rest part was about the returns automatically taken care. So we are going to discuss more about the how the exits can be controlled. So this is going to become a presentation more on the exit oriented unlisted investment opportunities. Let me figure out in that way. So that is something is going to come your way in next 20-25 minutes or maybe slightly more than that. Let me directly jump to the second part, that is about the background about the group. So as Manoj has said, we all belong to this Pantomath Group. So coming back to the background of Pantomath Group has been India's largest mid-market merchant bank. Merchant bank, as you all know, is the license issued by the regulators to do IPOs. So as a group, over a period of last 10 years, we have executed, if I were just to put a number, then we have executed 109 IPOs. In terms of number of IPOs, we rank number 4 into the country. So when I'm saying that we have executed so many IPOs, which are the 2 points that we have established? If you want to bring any IPO, the most important point is that you need to have the approval from the regulator. When it comes to unlisted segment, the most important point is that, so what we have established is regulatory approvals. Most of the time, IPOs do not come because the regulators do not give the approval. Regulators are more and more concerned about the safety of the investors. The returns come later, safety comes first. So if you are not following the regulations laid down, which are properly laid down into the IPO process, the approval is not going to come. So that is one thing we have established over a period of time, means 100 times we have gone to the regulators and got the approval. So we know what is exactly the process that needs to be followed for getting the approvals, point number 1. And point number 2, if you want to have the successful IPO, you need to have a good anchor investor. Anchor is a technical term. In a normal terminology, you can call it as a first investor or a long-term investors, that also you can call it. So these 2 things Pantomath has established in a very nice way, that we know what are the regulations that need to be followed. And we know that what is liked by the good anchor investors, what is their liking. So based on that, that is the reason why we are having good number of IPOs over a period of time. So that's very much about the Pantomath Group. Immediately about the Pantomath Group, I would also like to tell you about our one of the group entities, that is 𝐼𝐚𝐻. Most of you would have heard about this entity. This is India's the oldest broking house and intermediaries, 𝐼𝐚𝐻, having a 42 years old history. They started their operations way back in 1982, headed by Ms. Deena Mehta. So as we speak, Pantomath has a 52% stake into 𝐼𝐚𝐻. So what 𝐼𝐚𝐻 gives to Pantomath is that Pantomath has an excellent background when it comes to IPOs or till the date of IPO. But 𝐼𝐚𝐻 has given us a leverage to manage the show even post IPO, because that is how their good credentials comes into the picture. So they have the excellent institutional network, and that does come handy not only for doing the IPOs, but even managing the show post IPO. So these are the 2 companies that basically support the fund. One is the Pantomath Group's background, and second one is the 𝐼𝐚𝐻. Even before jumping on to the presentation, I would like to tell you something little bit more about the Pantomath's interest into the artificial intelligence. But before jumping onto that, I would like to put a small disclaimer. The fund does not believe or does not support the artificial intelligence investment. It is not a question of right or wrong. That is not the philosophy of the fund. But group does understand what is the benefit of artificial intelligence. So what the group has done, the group has made heavy investments, huge amount of investments in artificial intelligence. So today we have platforms, we have plenty of artificial intelligence platform, but the 2 main important platform which we have derived. So there is one platform called as Analyst.ai. What does it do? It, for example, listed company, everybody has all the data. There are plenty of websites that can give you about all the data about the listed companies. But when it comes to unlisted companies, that is the problem. The data is not so-called easily available into the public domain. So our artificial intelligence can give us any unlisted company, any kind of a data, right from the GST default of the company, TDS default of the company, criminal liabilities against the company, any cases against the company, not only the balance sheet and P&L and the industry report. So we have gone beyond that. So what does help us is that acceptance or a rejection of a deal, which is a technically problem in unlisted segment because you do not have a data so called easily able to make the decision. That becomes very easy for us. So that is investment number one. And second one investment is called as 𝐻𝐻𝐿. Both the platforms are owned by our group. 𝐻𝐻𝐿 helps us in generating the leads. So basically, it helps my investing company in growing their balance sheets. So that's about the group background. So now we can understand that based on the Pantomath's background, which is up to the date of IPO, Asit Mehta, which is post IPO, and the two artificial intelligence companies. So based on that, by now you all must have guessed what is coming your way, the fund. So this is completely an exit-oriented fund. So before going out to the fund and flashing the presentation, I would like to give a summary about the fund, which is the third part. This fund basically makes investment into such companies which are exitable in next 2 to 3 years times. So that is how we invest into the company. So rather than most of the fund management principle is that you enter into the company, you nurture the company, that is you grow the company, and then you try to exit the company. That is a traditional way. It is a correct way, but it is a long run way. So my philosophy is spot the exit first. That is decide that can I exit? Can I do the successful IPO based on so many years of experience? We have got an acumen to understand whether we can do or whether certain companies IPOable or not IPOable within a given span of time. So if I have to do a parallel comparison, when a private equity invests, they see how the company would perform after 7 years, 8 years, 9 years time. That is not a wrong concept. That is a right concept. So that is their concept. But my concept is when I invest in the company, I ask only two questions to myself. Question number one, based on my experience, can I go to the regulators and do I chance to get the regulatory approval in next 2 years times? At least I know what is required. And does I chance to get a subscription from one of the good anchor investors into this fund? If the answer to this question is yes, then invest. Otherwise, do not invest. That is the reason I clearly said this is completely an exit focused fund. So Manoj, I'm just going out to the presentation, going to flash the presentation. So as I said, we are going to discuss 4 points over here. The exit, number 2, entry, number 3, where do we make money, and number 4, the safety. These are the 4 things that we are going to discuss. So friends, let's talk about the exit first. So where my circle is there, that is called as the point of IPO. Post IPO, this is called as the post IPO scenario. So now you may ask me why this is called as the element of uncertainty. For the simple reason, post this point, you are subjected to market volatility. So it may so happen that the people who have deeper pockets than you, they have a license and liberty to play with your stock. So that is the reason we have called this as the element of uncertainty, where because we really do not know what is the step or what is the stand of other investors who have been invested with you. So that could be a game of challenge for you. Whereas here, you definitely know the other investors, their strategy is definitely known to me. So that is the reason I said this is called as the element of certainty, whereas post IPO is called as element of uncertainty. So first come exit, as most of you would have guessed. Get out, that is called exit on the day of IPO. Reason, on the day of IPO, officially your stock is the most liquid in the history of your company. Under the regulatory approval, technically, most of the companies bring their IPO up to 25%. The 25% of your stocks or somebody is buying and somebody is selling. At no point in the history of your company, your stock will be so liquid. So get out, that is exit, exactly on the day when the liquidity at its peak. So that is the reason I said exit on the day of IPO. And since I'm exiting on the day of IPO, let's decide the valuation. On that particular day, my valuation of the company should not be in excess of 4,000 to 5,000 crore. For the simple reason, we have a track record and a history to show we are a big company, 4 trillion economy. But unfortunately in India, the report does not suggest that not a good IPO we see above 5,000 crore. Not a good IPO. Last 5 years, probably we are not even seeing 5 IPOs above 5,000 crore and they have been very successful. But if I slightly tweak the question, how many successful IPO below 3,000 crore we have seen? Probably the answer will. So each and every sector, each and every segment, each and every product has their pricing ability. So that pushes us to believe that if we have to give a good exit or a good IPO, let's try to stick within the so-called as budget of India. So based on the past trend, that force us to believe that the budget of India is around 3,000, 4,000 crore. Plus, that goes well with our ability also. So we have a good ability to bring IPO into that category. So the valuation of the company should not be in excess of 4,000 to 5,000 crore and get out on the day of IPO. So now we have freezed our exit. As I said, decide the exit first and then see what is the entry. So I know here I'm going to exit. Now let's come to the entry. Now in entry, I have plenty of criteria, but the 4 or 5 main criteria which I'm going to discuss with you now. Number one, before I say about the entry, I might say something about certain industries or certain sectors or certain segment. Disclaimer, we are not against any segment, but that is my wish. So first thing is, what is the most easiest to bring the IPO? You cannot have two investors and you can bring the IPO. To get the IPO, you need to have HNIs also, you need to have retailers also, you need to have QIB also, and you need to have bigger investors also. So in Hindi, we commonly call that jo dikhta hai wo bikta hai. Means what you see, you buy. So always invest into the asset-backed company. So that is the reason asset-backed company are easily sellable. Basically, asset-backed means a brick and mortar. Because even retailers can also easily understand asset-backed company. So that is the reason point number one, invest into the asset-backed company. Second, invest into the companies whose top line is minimum 200 crore and not about 2000 crore. So very categorically, we have chosen this sector. You take any manufacturing company, 0 to 100 promoter takes time. 0 to 100 promoter takes time because he doesn't know the pulse of the business. But once he makes 150, 200 crore top line, that time he has got the pulse of the business. And exactly that moment, if you try to give him three things, number one, money, which I'm going to give. Number two, artificial intelligence, which I have heavily invested in my group companies. And number three, the corporate governance. In 3 years' time, that 300, 400 crore top line can easily go to 800, 900 crore top line because he has got the pulse of the business. From 200 to 2000, any company runs if they get a vitamin M, that is called as money. At 2000 crore, they will face a different competition called as competitors competition. So that becomes difficult. They have different challenges, I would say, after 2000 crore. So that is the reason we have chosen this path of a 200 crore top line to 2000 crore top line. So basically, you are going into the asset-backed company having a revenue proper. So there is no startup risk and there is no risk of having no assets into the company. Now let's go to the third parameter. There are various multiples that are currently flown into the market based on which companies are getting valued. Revenue multiple, EBITDA multiple, P multiple. Recently, I was discussing with Manoj. He told me about something called as a footfall multiple. I do not know what is that, but believe me, the most important or the most interesting parameters on which the anchor investors would invest is called as a PE multiple, price earning ratio. For that, you need to have a profit in your books. The most important problem is that most of the company does not have the net profit into the books. That is why they are forced to talk about the EBITDA multiple. But the moment you start talking about the P multiple, the probability of getting good anchor investor into your company goes very high. So now, friends, it's very simple. Since ultimately, if I have to sell on a P multiple, then might as well invest also into the P multiple. What does it mean? Invest only into the PAT positive companies. I might be making a little bit big statement, but there is a hardly any fund into the India, into the category 2 segment who has all PAT positive companies. So we invest only into the PAT positive companies. First fund, second fund, we invest only into the PAT positive companies. So asset back, top line, and PAT positive. And I would say the most epicenter of the presentation, the day we invest, the promoter should have minimum 90% stake into the company. See, asset-backed company, PAT positive, promoter having 90% stake. Normally, these kinds of company does not go zero. So what is I'm trying to ensure here is that your bottom line is at least protected. Always ensure the safety first, the return comes later. And the last and the most important factor, normally I do not speak a lot about this factor, is that whatever amount you are investing into any particular company, if the gross block of the company is more than 2.5 times and the promoter is having 90%, your money will never become zero. Because what does it mean? The promoter has technically invested 3 times of your investment. If his stake is 3 times of your investment, that means your money is safe. So what I'm trying to deliver is more than the return. I'm trying to deliver a safe product. So we have seen that all my entry criteria are completely keeping the exit in mind. So we have seen 2 parts of the technical presentation. The exit we have seen, the entry we have seen. Let's quickly see the last 2 parts. Where do we make money? Paisa ka kamate hain? Most of you must have guessed by now that I'm going to play ultimately the game of P multiple. P multiple का formula ये है PAT multiplied by P multiple is equal to valuation. So let's come to A. A in my presentation is PAT and P is P multiple. So if you have seen the way I have explained about the entry, I have nowhere mentioned that I'm trying to convert a loss-making company into a profitable company. No, I never said that. I never said that I am trying to convert a bankrupt company into a profitable company. I never said that. I never said that I'm trying to convert a 10,000 crore company into the 15,000 crore company. No. But again, friends, coming back to the same explanation, 400, 500 crore top line company, at that company, you give him money, you give him corporate governance, and you give him artificial intelligence, the balance sheet grows. Definitely it grows. So basically, what I'm trying to do is from the time of entry till the time of exit, I'm going to increase the PAT, which is called A of the company. So A is PAT. And I have explained you how exactly I'm going to do it. Let's come to, and that is what I have demonstrated in my first fund also, how it happens. Let's come to the B. B is P multiple. Now, what is the benefit of P multiple? Unlisted company, listed company, you come at a, say a multiple of 40, P multiple of 40, and unlisted, you have to come at a P multiple of 30. Reason being, listed you can buy Friday, sell Monday. Unlisted you cannot do that. So that is the reason you have that liquidity discount. But we do not come at 30, we come at a much lower discount. That I'll come later on. So basically, it is my ability to convert an illiquid stock into liquid stock. Gives me that delta. I repeat again, you should have the, that is the reason I said, unlisted sector, you can make more money, provided your fund manager knows how to make an exit. So come at a lower multiple and exit at a higher multiple, provided you can do exit. So in simple mathematics, A is PAT, B is P, double the PAT, double the P multiple. By default, the valuation goes 4 times. That is why the fund is slightly attractive. I'm not trying to promote or anything, promising anything, but just giving a mathematical calculation. So predominantly, this is how the investors in India have made their money. Rather than going at a traditional new age valuation technologies of revenue multiple and EBITDA multiple, traditionally, India has made their money based on P multiple. And that is exactly, this is not a new technology. This is not a new fund management tactics. This has been an old fund management tactics. Only thing I'm trying to repeatedly saying, come back to the old fashioned school. This is not a new fashion invention at all. So we discussed the third part also, where do we make money? Let's come to the last part, safety. So safety means 3 criteria. Whenever I invest into any companies, I have 3 points into my shareholders agreement. The first point, the day I invest, the promoter of the company has to bring the IPO in 30 months flat. And I take the right of appointing the merchant banker. So now what happens is that, which are these companies? First of all, these are smaller companies within the budget of India. Second, this is a known companies, because asset bank company, people understand this. So the probability of IPO is very high. But let's take a downside. IPO nahi hai for some reason. It normally doesn't happen, but in worst case, if happens, then immediately the 2 clauses trigger. And these clauses are very common. Then you'll come and ask me what is the difference. The second clause, most of you must have guessed, is nothing but stake sale. I can go and sell it to somebody else, or there is a buyback. Now, having a buyback arrangement with the promoter having 30% stake and having a buyback arrangement with promoter having 90% stake is a big difference. This is not a startup promoter who has given me a buyback right. This is a promoter having a top line of buy now 800 crore, 900 crore. If you see my first fund, the average top line of the companies are in the range of 800 crore, 900 crore, where promoter is having 85 to 90% stake. If that promoter gives you an assurance that if the IPO doesn't come, I will stand behind you and I will buy your shares, I guess you can trust that statement. So what I'm trying to do over here is that the biggest principle of fund management is called as the principle of totality. Principle of totality means you make 10 investments. You cannot convert your first investment of 100 crore into 200 crore and then go out to the world and say, I have doubled the investment. No, because if the next 100 becomes 0, you invested 200, you got 200. So if I have to explain this in a little bit cricketing language, because India understands cricket very well. In cricket, if you want to win the matches, then top order plus bottom order is equal to total runs. The top orders are your IPOs. By default, they are destined to give you good returns. But bottom order can also give you a good buyback option, wherein normally the buybacks are in the range of 18 to 24% IRR. So that is how I have protected my top order also. And that is how I protected my bottom order also. So in fund management, you have to protect, because you are going to do a good returns. But if you try to protect your bottom line also, That's where you get an extra push and you get an extra delta as compared to the other investors. So this was the little bit of a technical presentation quickly. Exit on the day of IPO at a valuation not above 4,000 crore. Entry into the asset-backed company having a revenue of minimum 200 crore, PAT positive, promoter having 90%, and make sure that whatever sum you invest, the gross block is at least 2 times. Where do we make money is we clearly play the game of double income, that is increase the PAT, increase the P multiple. This was a traditional game and India has witnessed this over a period of years. Unfortunately, most of the investors have forgotten and I'm asking them to come back. And we discussed the safety mechanism also, where I have right to go for the IPO right from appointing the merchant maker. And I also have the buyback arrangements with the promoter. And these are grown-up promoters. These are not the startup promoters who are giving you the buyback arrangement. So that is how the fund has been structured. Manoj, I'll just take 2 or 3 more minutes just to little bit go deeper into the presentation.
Yes, sir.
Uh, this is most of the time people do come and ask, where do you invest? So what we believe is that asset-backed company, but rural consumption, that is our theme. So rather than telling you where do I invest, where do we do not invest is slightly ethical businesses. So tobacco, alcohol, gambling, animal killing, and gaming. These are the sectors normally we do not invest. The most important point I would like to mention over here is that you do any business, you do any business. If the entry and exit you try to control, then you can do a good business. It may be my business, Manoj, it could be your business. But if you have the control over entry and exit, because if you do not control the entry and exit, then you will have a push from down also, you will have a push from up also. Then what you will happen is nothing but sandwich. So what we are trying to establish over is that we have the control over exit also, and we have the control over entry also. So entry and exit mechanism is properly controlled. One important point I would like to mention is that each and every company has their quant model. Quant is basically the rating model, as simple as that. So whenever you invest into any company, the fund manager does a typical quant model, wherein if you score more than 70%, they would consider for investment. If it's more than less than 70, they will not consider for investment. Normally, most of the fund will not reveal the quant model. But one thing I would like to say that most of the funds have more than 80% weightage given to the financial metrics. In my fund, more than 30% weightage is given to a behavioral due diligence. This is a specific slide I have mentioned in my presentation also, and I keep on talking a lot about behavioral due diligence. What does behavioral due diligence means? You invest in any company. If the promoter's mindset is not there to return your money, then your company might be at a 30-35% EBITDA or 30-35% PAT. You are never going to get back your money. That is called as a behavioral due diligence. You need to understand the mindset of the promoter. Right from what time he comes to the office, where he is investing, about his entire background. So the reason why we are invested heavily into the artificial intelligence is to understand the behavioral due diligence of the company. Unfortunately, most of the time, fund managers do not do this kind of a due diligence. What is behavioral due diligence? This is beyond books of accounts. This is beyond regulatory. So that is the reason I have included a specific slide about the behavioral due diligence into my presentation. Very quickly, a quick comparison with a disclaimer. This point is that I'm not trying to show that I am the best guy into the planet, but a quick comparison. Where does this fund stand as compared to the rest of the peers? Again, with a disclaimer, this is only take it from the education point of view. So this fund is the shortest tenure of 5 years, whereas most of the funds are more than 8 years or 10 years. We do take active ownership approach into the day-to-day operations of the company. Most important is virgin investments. So in first fund also, none of my investing companies have more than 3 or 4 investors. So basically, I believe in cutting the first check, not a startup, a grown-up company cutting the first check. So I would like to explain a little bit different way. This is how I explain to people. Imagine IPO is like a bridge and investors like a car. We always say that. More the number of cars, you will have something called as a bottleneck into the bridge. I'm not against startup, but look at the most of the startup. By the time they do not even touch 50 crore top line, they have more than 25, 30 investors. How can you bring IPO when you have 25, 30 investors making everybody's thinking something different? So what we are ensured in fund one is also is that in none of my investing companies, I have fourth investor. So first is the promoter, second is my fund, and third, we give co-investment opportunity only to the investors of the fund. So what I have ensured is that I have not only kept the IPO option ready, open, but clean also. So the day IPO comes, the only one car will climb that bridge. That is called my fund. That is called not only keeping an exit option, I have kept it absolutely open also. So that is the reason I mentioned we invest into the virgin assets. Exit capabilities, I already mentioned at the start of my presentation, in-house. Entry also in-house. Dry powder is basically carrying the money and not investing. That doesn't happen. We draw the money only when it is a requirement. So investors do not have the burden of immediate investment. And exit strategy is IPO. I would like to talk 2 minutes over here. Most of the people come and say there are only three ways of exit: IPO, private equity, and mergers and acquisition. So I always ask people, anybody, that you talk about private equity and you talk about mergers and acquisition. I also done many PE transactions in my life. I also done any M&A transaction. But there are no set benchmark or no set rules and regulations for that. So you follow certain process that you do process number 1, 2, 3, 4. At the end of the fourth, you will have your private equity. Or you do 1, 2, 3, 4 step. At the end of the fifth step, you will have your mergers and acquisition. So the steps to be done are not well defined. Whereas in IPO, the regulators have a well-defined steps. You follow step 1, step 2, step 3, step 4, the regulatory point of view. At the end of the steps, the regulators will give you the approval. Because what is required to get the approval and what is not required to get the approval is the process. So what point I'm trying to make from business point of view, that if you want to do anything big in your life, try to enter into the process-oriented environment. And IPO is a completely process-oriented environment. If you have the habit of following the process, the success will definitely come. So that is the reason we have habit of following the process. That is the reason we have opted exits through IPO. Very quickly, team, Madhu is there, I am there, and Prasanna is there. Madhu is the rank holder chartered accountant, and she was the youngest CFO of the Edelweiss Asset Management. She has been there. Madhu and I both were the part of the first fund also. And recently we included Prasanna. Prasanna was the CEO of a Taurus Mutual Fund. So amongst three of us, if I have to talk about the capabilities, then Madhu comes more from the point of view of entry. I come more from the point of view of growth of the company, and Prasanna comes more from the point of view of setting up the MSS and controls and regulations of the company. So this is how we have differentiated the roles and responsibilities amongst us. Last slide, Pranavji, before we go for a question and answers. This is the highest product of SEBI. Today, SEBI does not have any product beyond this. I'm not telling this to threaten you, but just to tell you that this is the highest regulated product. So we are subjected to 4 audits. First audit is Deloitte, which audits the books of accounts. The second is whatever agreement the fund manager and the investor enters, regulators does a separate audit of that, and the report directly goes to the SEBI. So there is an evaluation between the agreement that we enter with our investor. The regulators get a separate report of that in addition to the Deloitte's report. Plus, SEBI has kept quite a, you can, in a normal term, you can call it a trustee. We also call it as a watchdog to observe each and every transaction. So Orbis is the trustee and RT agent is the CAMS. So this is how the fund has been structured. Very quickly in 1 minute summarization is this is a category 2 fund. As I said, 1,000 crore plus 1,000 crore fund. The fund period is 5 years. The management fee is 2%. We have completely waived the setup fee. Most of the people charge. Hurdle rate is 10%. Compounding carried interest is 20%, and auditor is Deloitte. So very short in summarized way, what we are trying to do, we are trying to build a structure to show an exit-oriented category 2 AIF. So Manorji, if I have gone a little bit fast on my presentation, my apologies for the same, but I hope I have done a justice to the limited time of 20-25 minutes you have given to me. So we can go for a question and answer. Whatever questions your team wants to ask me, feel free, you can ask me.
Thanks a lot, sir. It was a very interesting presentation. We had a few questions lined up. So in your first fund, you had 150 investors. And in your second fund, already you have around 125 investors. So if I may ask, what is it, what is the traction? What is the investor confidence? What is it that, is attracting them to your fund?
So Manoj, I can give you maybe we always ask investors if they're trying to invest in my fund, what did you like about my fund? So I can give you 3 reasons, Manoj. And the 3 reasons which investors have said, we all stay in metro. In metro, there's a concept called as a floor rise. That's a real estate concept. That means as you grow high, you have to pay the premium for your house. So that's a real estate floor rise. Let's see what is the floor rise of a capital market for 2 minutes. In any company, first comes the promoter. Nobody can make more money than the promoter. That's a given fact. The second comes my fund at number 2. The third comes anchor investor, which is SEBI or RBI registered people. The fourth and the fifth, the HNI and the retailers who apply before the IPO, unfortunately, nobody gets into the IPO. Even if you get, you do not get more than 15,000 rupees nowadays. So technically, even if you get, it has no meaning. The sixth comes the so-called India's strongest investor called as mutual fund, and seven comes the retailers. So in an entire supply chain, the retail investors have no option but to come at number seven. So, and each and every entry has a premium. Each and every entry has a premium. If you talk about my last IPO, from here, it was a 10 rupee per share. Till here, it went to 130 rupees per share. So that was the premium I'm talking about, from 10 rupee to 130 rupee. So now it is a question which most of the investors tell me that we do not want to come at number seven. And in a race, not to come at number seven, but to get the discount of number two, people have gone and invested into the startup. Now, startup has a different race. So in this fund, I am not charging the premium of number seven, but to give you a discount of number two, that too also on a company which is likely to go for IPO in 2 to 3 years times. So Manoj, that is a point number one, completely as per the floor rise of capital market. Point number two, unlisted, you tend to make more money provided your fund manager knows how to make an exit. And that is what I have demonstrated till today. And point number three, Manoj, you do any business in your life, be it your business, be it my business. If your buyers are rich, your business is not going to die out. And who are my buyers? I kept on saying 3-4 times that I'm going to exit on the day of IPO. So when I'm making a statement time and again that I'm going to exit on the day of IPO, means my buyers are mutual funds and the banks. So point here is that they cannot come over here, which is unlisted, and I am not going to go into the listed segment. So their entry is my exit. And as long as my buyers are rich. So for example, in other way, I can say, if you try to think that mutual fund interest is 18,500 crore every month, it was 15,000 crore, which Manoj, when we spoke about 6 months ago. So if you think that this industry is going to go down over a period of time, which is highly unlikely, yes, I'm into a slightly difficult position. But if you think that this industry is going to grow, then yes, I'm in a favorable position because my buyer is getting richer day by day. So these are the three reasons, Manoj, which I could summarize why people have chosen to invest into the fund in a very non-technical way.
Sure. The second question is, as an investment advisor, which category of investors should invest in this product and who should not?
As an investor. Okay, Manoj, you're a better, I could be a fund manager, but you are a better wealth manager than me. But I would like to answer this question, but probably you can also confirm after I answer. The minimum investment as prescribed by SEBI is 1 crore. This is the beyond PMS. So 1 crore per PAN card. And what we suggest to viewers and listeners is that do not park the money which is of immediate requirements to you. Do not do that mistake. Every person has a investable surplus. So this product, I would say, is good for, let me answer it another way. Most of the people who have financial assets in excess of 4 to 5 crore, they have chosen AIF route. And financial asset does not include ghar, gaadi, bangla. So your house and your car does not, it is not a net worth. So I did not mention net worth. I said the financial assets. So I would say, Manoj, this product is good for the people whose financial assets are in excess of 4 to 5 crore. I stand corrected by you. I hope you agree with my statement.
Got it, sir. And since you are on the fund and you said the investment size is 1 crore. So what is the amount of drawdown and the initial drawdown?
So Manoj, here the investors, unlike first fund, which went very aggressively, the second fund has a relatively relaxed drawdown. So you can expect a drawdown of 20% starting from this month. And 20% you can expect quarterly coming to you. So for example, if you're investing 1 crore, then the 20% drawdown comes to 20 lakhs coming every quarterly that you can expect. So over a period of 1 year, 3 months, the entire money will be drawn. And normally I have a clause of 30 months of the IPO. So as and when I get the exit, your money would be coming back because most important, I'm not going to reinvest. So you are investing into the batches and the exit would also be into the batches. So the first entry and last exit would be on a 4 years. That is the reason we have gone and registered the fund for 5 years. But that does not mean your entire capital is going to be with me for 5 years. So by the time you enter, it will be 12 months. And from 30th months onwards, the exit would start. So your entire capital is not going to be with me beyond, on a higher side, I would say 2 years. That's what my expectations are. So 20% drawdown could come every quarter.
Got it, sir. And so on the taxation part, being a category two, it would be a pass-through status, right?
Yes. So taxation is basically I need to deduct the TDS, and the TDS certificates will come to you. So let me give a little bit quick understanding of the tax. If you are an Indian resident, then if it is a listed exit, then short term, long term would be 10, short term would be 15. If I try to make an exit into the unlisted, the probability is very less. But let me still, if we do that, again I repeat, probability is very less. Then the long term would be 20% with the indexation, and short term would be at the highest level.
Ah, got it, sir. And since this is your second fund, could you briefly update about your first fund? What is the current NAV? And for the investors who entered, before the first close, where do they stand as of now?
So first fund, the important point is that we have almost deployed 65%. So fastest to deploy 65%. We managed to deploy within 4 months of our final close. We managed to deploy that money. Good point. Each and every company we have invested, invariably a bigger investor has come and invested in those companies. This year itself, we are planning one more IPO. So the investors who are, I could see a couple of names who have invested into first fund are listening this presentation. So they can expect the exit in this year itself. And you asked me a specific question about the NAV. So investors who have invested as a part of my first closure into the first fund, their NAV stands 1.76. That means 100 has become 176 over a period of 1 year and 8 months, 1 year and 7 months. So that is how where they stand right now.
That's pretty attractive. And this is the question which is almost everybody's going to ask you for. What is the sort of expected returns for this fund? Or rather,
So,
what should be the expectation one should be, setting?
so Manoj, I know this call is getting recorded. So let me address this question a little bit different way. I just now mentioned 100 has become 176.
Correct.
So this is not a listed. So this is not the valuation at all. This is what I keep on telling the people. 100 has become 176 because after me, somebody has invested at 176, which means I entered at 100 and somebody else came at 176. By the time I go for the IPO, it will be much higher for that because the listed segment is much higher. So what we do, Manoj, is that at the start of my presentation, I said if the listed P multiple is 40, we try to come at 30. So technically, we do not come at 30 because we are like a one-stop shop for the promoter's requirement. So we ask a heavy discount to the promoter. So my first P fund, the average P multiple is 11.5. If I have tried to enter at 11.5, Manoj, you also know in my segment, the current P multiple is definitely in excess of 30. So we always believe, Manoj, try to come as low as you can. If you try to come as low as you can, then technically from there the market goes up. You tend to earn more money because you are entered at a lower valuation. But even if market falls, you have that buffer to capture. So that is the reason I said 11.5 P multiple. On a P multiple itself, Manoj, you can guess what could be the exit level because I do not see any sectors that we have invested currently are below the P multiple of 30-35. Plus the PAT is definitely going to grow and it's a double income. So if I'm exiting at 30, enter at 12, then 30 divided by 12, 2.5 only you earn on a P multiple. Plus PAT is a different game.
Got it, sir. Got it, sir. Yeah, I think that answers quite a few questions which I have on the Q&A box also. Yeah, coming to next question. So we understand your buy side is a promoter of the company in which you invest. So who are your sell side for the product?
So yeah, I could see one. I'm just taking the question over here that what is the buy side and how do you earn? So let me go a little bit deep into the buy side, Manoj, with your kind permission because I could read that question over here is that. So what happens, Manoj, here is that try to gauge a Indian promoter, suppose having a 400 crore or 500 crore promoter, manufacturing sector. Most of the funds are not supporting this kind of a sector. That's what we earn the mileage over them because that is not. So from 400, if he has to go to 5,000, 4,000, what are the steps he has to follow? First of all, he has to appoint a good financial consultant. Not everybody is lucky to have somebody like you. Then financial consultant, that is a step two, he has to get a private equity investor. The private equity investor would tell him that you give me the exit. So to give the exit to the private equity investor, he has to go to the appoint a merchant banker. Then he has to go to the regulators to get the approval. Then he has to get the anchor investor. Then post-anchor investor has to manage the post-IPO issue also. That is the reason if you see a good promoter, most of the good promoters, rather than tier 2, tier 3 promoters, rather than sitting in their dugout, you find them sitting in the Mumbai at a financial consultant's house, because their job becomes raising the funds one after another. So how do we come handy is that once the promoter comes and we like the company, we become the one-stop shop. So from tomorrow onwards, my suggestion to promoter is that don't worry, I'm only a financial consultant. Number one, I'm only going to be a private equity investor. I only know how to get file the DRHP. I know how to get the IPO. I know how to get the anchor investors. So from here, 300 crore your top line to 3,000 crore, you have a one-stop shop that is called as me. You do only one thing. You take my money. You take my artificial intelligence. You take my corporate governance, and please help me to grow that revenue. In lieu of that, what we request is, again coming back to the same P multiple, listed 40, unlisted 30. I will not come at 30. I will come at 15. Give me that 10% stake at a substantial discount. What does promoter think? He thinks how much he's losing. In a 10% equity, he is giving out a 50% discount. That's a 4%, 5% loss, Manoj. No misunderstanding, but otherwise market, the private equity fundraising is nothing less than 4% to 5%. Plus your average waiting time is nothing less than 8 months to 9 months to raise the fund. Plus you do not know who is going to be the investor. The color of the money is same. If somebody is getting a quick money, that too also in the view of one-stop shop, that he doesn't have to do anything from 300 to 3,000, he might as well take a bet and give me that discount. That is the reason why I managed to enter at a 11.5 P multiple. First of all, I'm talking the language of P multiple. Very few investors or very few fund managers catering to category 2 would talk about the P multiple. Most of the people would not talk because they do not have at all PAT positive companies. So I'm talking the language of P multiple, that too also not a heavy P multiple. So Manoj, you can expect when I'm talking about the P multiple of 11.5, when it comes to revenue multiple, it goes below 0.7. So that is where I earn the mileage when it comes to my buy side. Now the buy side, keep it so low that you are not going to get affected by your sell side. So market from here will go where you do not know. It can go anywhere. 99.9% is going to go up only. But still what I'm trying to say over is that we have created enough gap between the buy side and sell side. So my buy side, how I get the mileage, that I explain. My sell side is nothing but the mutual fund. So as long as they are getting stronger day by day, I think I'm into the safe pair of hands. I would like to say like that. And if you Google it, you will come to know who are my buyers.
Yeah, so a general question on the IPO market itself. So while comparing the IPO that got listed in 2023 and 22, the companies which got listed in 2023 have done a better returns. How do you see this going forward?
So, Manaji, many people come and ask me why the number of IPOs are trying to increase in India. So my analysis is a little bit different, and this is not a political statement. But what we have done is that if you are watching the IPL nowadays, each and every cricketer is coming and advertising mutual fund. Mutual fund सही है, सोच कर समझ कर invest कर. These are all captions they have given to increase the AUM of so-called as mutual fund. Now this mutual fund have increased size a lot. Now once you increase, each and every rich man has only one problem, and that problem is where to invest. The issue is not where to exit. If you ask the rich person, they will say where to invest is my problem. So now these mutual funds, unfortunately, they cannot come into the unlisted space. They have to invest into the listed space only. So as long as they are getting stronger day by day, it becomes the so what to support that, they have more and more companies have to pass through the IPO channel. Now more and more companies have to pass the IPO channel. That is the reason the anchor's holding period has come down from 12 months to 6 months, from 6 months to 3 months, and from 3 months to it is now 50% 1 month, 50% 3 months. So supposing you are a fund manager of a same mutual fund, reputed mutual fund, and earlier Manoj ji was doing 4 IPO in a year. Now with the same capital, you are allowed to do 24 IPOs. Because earlier your lock-in was 12 months. Now your lock-in is technically 2 months. So since the lock-in has gone up 6 times, your probability of doing, you have increased the probability of doing more IPO. So what they have done is that they have increased the liquidity amongst the anchor sector. And because the liquidity for anchor has increased, the probability of having more IPOs has increased. So as long as you do not, so there are two factors. As long as mutual fund industry is getting stronger, and as long as that anchor lock-in does not go from 3 months back to 12 months, this industry is going to go. And both goes hand in hand. You cannot increase the AUM of the mutual fund and tell anchor, no, we'll once again go and increase your lock-in. Because if they increase the lock-in, the number of IPOs will reduce. The number of IPOs reduce, mutual fund will not get an avenues to invest. So both goes hand in hand.
Got it, sir. The other question was, what are your key learnings from your past experience while picking up companies? Do you see some common trait in them?
So, Manoj, it's very simple. What we do is that we have the reason why we have invested into the sector that we do. The selection parameters, Manoj, that we have chosen. If we try to stick to that selection criteria, then success is definitely going to come. The selection criteria is very strong. Asset back, PAT positive companies, promoter having 90% stake. Whatever we invest, the gross block has to be more than 2.5x. So if we try to achieve this selection criteria, I don't think we will fail. And even if how much will succeed, that's a secondary question. But at least the bottom line will get protected. So the question here is that the fund manager as a group of fund managers, we have laid down our entry criteria very much categorically. The question is how far or how successfully we do not deviate from that. The moment we try to deviate from that, we are avoiding a trouble. But as far as we are concerned, till today, we have never ever deviated from the selection criteria that we have set. So as long as you are well within our selection criteria, I think we are in a safe pair of hands.
Got it, sir. We have a question from one of our participants. He wants to know, how do you use AI to assess promoter behavior? If you could give some examples.
Classic, plenty of examples, but I can give you one classic example. One of the, when promoter comes, no misunderstanding, Manoj, you would appreciate this fact. They show you sky and the moon. They'll come and show that my company is the best in the world. So on the classic promoter, yesterday came to our office and say that I have 266 employees. In front of him, I could show him that you are paying the PF of only 52 employees. Oh. So classic, and it happened in 52 minutes. It happened in less than 12 minutes. In less than 15 minutes, I could show him that you might have 266 employees, but you are paying the PF of only 52 employees. You have not paid your GST for less 6 months. And there was no explanation required beyond that. So you might be a 50% EBITDA company, but if you're not paying your GST on time, Manoj, that shows your intent. Sorry, I'm not targeting you. I'm saying you as a promoter. So there are plenty of examples like that. Another AI company is that one of our investing company, we gave them the predictive maintenance cycle. So based on the maintenance that they have been doing for last 10 years, now the promoter knows exactly when his major shutdown is going to happen. And it is an AI model. They have used your 10 years history. So what happens is that when he knows where the major shutdown is going to happen, that time he can do a major refurbishment work. Otherwise, what happens? He has shut down the factory for major refurbishment now, and once again he is going to shut down the factory when major shutdown comes. So if you could do both the things together, and he has certain product which goes on a per minute basis. So if the minute goes down, wasted, his revenue goes down. So that particularly helped him a lot. So there are plenty of examples like that. Another example is that one of our investing company itself used to sell their products to Germany for a long period of time. I do not want to name that, but just running through, and they had a long presence into Germany for over about 8 years, 9 years. So when they pitched to us, they had a pride in saying that we have good foothold into the German market through our AI. Just by running few permutation combinations into the LinkedIn, we could give them the more distributors into the domain where they thought that they are the best. So in Germany, we could tell them that you are currently dealing with 8 or 9. Please look into this. These are 5 more who have more capacity than your business. So this kind of a business generation can happen only through AI. There are plenty of examples. I can keep on talking. We can have another seminar on this one day probably, because this topic is very near and dear to my heart.
I think, yeah, it's pretty interesting, sir. Yeah, and maybe the last question, if I could take, how do you differentiate your product from your competitors? Because we have seen pre-IPOs from other fund houses also.
So Manoj, I would like to put a 1 second disclaimer here because this is when speaking in a public domain. What happens is that always try to stay in a so-called away from competition. So if you try to open the balance sheet of most of the category 2 AIF, I'm not talking about the debt fund, remove the debt fund, remove the real estate fund. But if you try to see the 8 companies, you would invariably find into the balance sheets of the fund managers. They are like, again, that is a strategy. I'm not saying the companies are bad, so no misunderstanding. They are like Ola, Zomato, Nazara, NSC, Baiju, Pharmacy. So these are the companies. And the balance 20% would have startups. So people are either talking about the big boys, that is about 25,000, 50,000 crore companies. Again, I'm not saying that's a strategy is right or wrong, but that is their strategy. And the rest, so 80% into that category and balance 20% of the startup. But the mid market, where India has traditionally made the money, asset back, PAT positive, very few funds are there into this category to support them. So that is where we get the advantage over the others because so-called, since nobody else are giving them a money, when you're away from the competition, you're going to get the success. So that is why we have chosen this field. I would say that is how I would not use the word beat the competition, but that is how we are away from the competition.
Got it. Yeah, I think we almost run out of time, sir. It was a very, very insightful session, sir. I'm sure most of our participants have also immensely benefited from this session. Uh, I think that's about it, sir. Yeah, I hope you have a great weekend and
I would just like to say, Manoj, a line to this that just to all the viewers that take this seminar as a part of education exercises, and they need to use your own due diligence before investing into anything. And anybody wants to contact me separately, that is also good. But you have to use your own diligence from the point of view of investment. So a small disclaimer I would like to mention on behalf of both of us, Manoj, you and me, both of
sure,
us.
sure. Yeah, yeah. Thank you, sir. Yeah.
Thank you. Thank you. Thank you. Thank you.